Hey everybody, Economic Ninja here. I hope you're doing well. I've got a really neat thing we're going to go through today. We're going to talk about mortgage rates and how that pressure is building and how I believe we are already seeing the collapse in the real estate market, unless of course the Fed pulls a rabbit out of a hat and goes into negative rates, which quite frankly I would be shocked at, because if they did, it would only make inflation much worse. Also really looking into hyperinflation in the currency. So we're going to jump in. I'm going to share the screens. We're going to go over a story first that I think really grabs the essence of what's going on here in the mortgage market. And it's entitled, "Here's How Much the Same Mortgage Costs Now Compared to Last Year." Now, guys, we know that the 10-year bond is starting to bump up against that 3% mark. And it is pretty gnarly, because right now there are some mortgage companies out there literally asking for 6.125% interest rate for a mortgage, for a 30-year fix. That's just absolutely mind-blowing to me. Not that it's a big number, because I'm used to investing. I was, when I first bought my first rental property, I was paying 7 3/4 for my first residential rental property, and that was in 2001. Okay, so that's not big to me, but for homeowners, it is a big deal. Okay, it says obviously fewer people are shopping for homes, a sign that home buyers are getting priced out of the market due to surging mortgage rates, which spiked to an average of 5% this week for a 30-year fixed mortgage rate. And again, that average is for stellar credit too. I want to remind people that's 0 points stellar credit. The fixed rate mortgage rate jumped almost 1/3% in the last week alone, reaching a high not seen since February 2011. And again, guys, that's very important, because 2011 is when we were bottoming in the real estate market after the Great Recession had started. So right here, it says a year ago, a 30-year rate averaged 3%, which is nearly 2% lower than the rate now. Now, here we go. Here's the numbers, and we're going to get into some charts. For a home worth $408,000, that's the median home price in America, with a 20% down payment. Okay, and I want to remind people, not everybody has a 20% down payment for the median home. All right, unless they're borrowing from their family or they're borrowing against a retirement fund, not everybody has $80,000 put towards a home. Okay, so I want to explain that to people, because that again is what also plays into what kind of loan you're getting, the rate, the terms, all that stuff. So it says for the median price home with 20% down payment, 30-year fixed rate at 5%, the mortgage monthly cost would come to $1,750 a month, right? Now, a year ago, and not even a year ago, as a matter of fact, as early as the first week in December of 2021, so merely, 4 or 5 months ago, the monthly mortgage payments would have come to $1,383. Okay, that's $400 less, or nearly $400 less. Now think about $400 when we're talking about the average income in the nation. That is a lot of money. That is a car payment in a lot of people's on balance sheets. It is a lot of money for a family to be able to fork over as an additional cost. And the sad thing is, we're going to see in these charts, I don't think this is ending anytime soon. All right. So when we talk about deflation, and I'm trying to bring people into the realization that it's happening, it's starting right now. Okay. This month, prices went up all across the board: food, fuel, energy, natural gas is exploding in price. Things are becoming more unbearable for families to be able to not only save money, just pay the bills. All right. So what happens is they start to immediately retract their spending. All right. And you're probably going to see it in Netflix earnings. I'm filming this prior to the Netflix numbers coming out. So you're probably going to start to see subscriptions fall off of a cliff, because we are seeing more and more pressure put on the American family. All right. Now let's dive in over here. Now, this is the number of existing homes sold in the United States from 2005 to 2023. Now, 2005 is a pivotal number. This is our year. This is the year where I had figured out, oh my gosh, this thing is crashing, and I'm gonna go into why in a second. But 2005 is when I started to liquidate my real estate holdings. It was about mid 2005, and by mid 2006, I was completely out. And the reason why we started to see home prices decline, and again, I want to remind people, all right, because we've been talking about deflation starting, and it's only going to start in a couple of sectors until the Fed pulls in and does some things. We're going to start doing more videos on this, because I want people to see this in real time. Okay, we are not a historian. We are looking to the future, but we're basing the future, what we predict in the future. And again, none of this is financial advice. I'm not a financial professional. I'm an investor. I make money. That's what my job is. That's what I like to do. I love to watch my money grow and make money. I like watching other people make money. That's what gets me going. Okay. I'm not a historian, so I don't listen to people and go, oh, we're in a recession now. Well, how do you know that, genius? Well, it's because I look back in the past and our GDP has declined. Okay, I mean, come on, oh gosh. I mean, it's like, why are we paying these people, right? So the Great Recession started in, everyone marks it as 2008, right? That's when everything came apart. Well, it came apart. And I want people to realize that we're collapsing right now because you saw many things happening. One of them was here. Home sales started to decline. Well, when home sales decline, the same amount of people on average need to sell their home, right? So if they can't find a buyer, what do they do to sell their home? They lower their price. That's the first thing they usually do. Well, first thing they usually do is fix it up and add add-ons, incentives. But primarily they end up lowering their price. And so what happens is all these years, boom, 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 boom. Here, this is the year right here, Lehman Brothers crashed. Now it did bottom right here in home sales, and you started to see it rise, right? Well, now let's talk about currently. This year right here, this is the year, sorry, right here. 2021, this is the year everyone's talking about. Housing's exploding, housing's exploding. Does it look like it's exploding to you? This is the national average. Now I get it. People are gonna pull up and a lot of articles are gonna come out of California. Well, no duh, California had a lot of home sales. People are running away from it, okay? That makes sense. It's like that stupid statistic the insurance companies put out. You are more likely to get in an accident within a radius of 10 miles from your home. Okay, well, idiots, how often, and I'm talking to the insurance companies, the statisticians, how often am I further than 11 miles or 12 miles from my home, right? And think about that. Even when I'm going 20 miles from my home, I'm still within 11 miles before I cross that imaginary barrier of safety, right? Ooh, good, I'm outside of that barrier. My drive is gonna be a lot safer, right? And that's the thing we need to realize, okay? People, we pay people way too much for their opinions when they get on CNBC and they have a fancy suit. And I'm going to be honest with you. I know some people that have sat in those chairs. They don't even own their own home. And they're telling you what you should be doing. Oh, man, it's insane. Sorry, the ninja just is letting loose. This is the ninja unplugged. So you tell me, does that look like an insane bumper crop year? No, it is not. It's not. The facts are not that many homes sold in comparison to what we saw in that that's 2 cycles ago, the real estate crash, right? And so this is where we are right now. And these are their projections. Now, this is where I think their projections are completely wrong. All right. Okay, here, let me caveat this. Okay, these projections are based off of a percentage of what's happened in the past 10 years. Now, check this out. This is the 30-year fixed mortgage rate average in the United States. Now I'm going to explain some things going back to when I was investing heavily into real estate. The reason why I got into real estate was because of this very special event right here. This right here, March 2000, not that exact day. That's when the dot-com bubble burst. That was it. Now, if you notice, the dot-com bubble burst and people finally started to liquidate all of their NASDAQ stocks, right, or tech stocks. And you can see, now this is interest rates. You're going, Ninja, why are you telling me about this? Well, first off, the wealth effect was just shattered. From a period of what, essentially it started in 1994, but really when it started to ramp up was right around here when rates started to pick up. That wealth effect was blowing up. People were getting wealthy. It was all over the news. These tech stocks were booming, but then they broke, right? And you could see, even for a little bit of time from March to the spring of 2000 to right about here, May of 2000, a couple of months went by before the Federal Reserve knew that they had to start lowering interest rates. And that is when I got pumped, because I got into real estate right around here. And the reason why I got into it, not only did I buy my own home, but I started buying up residential real estate like crazy because I was reading the Federal Reserve meeting minutes, and they were saying this is a long-term trend. We are going to be dropping rates for years. And so I saw this 30-year mortgage drop. And think about it. When I told you my first residential property was around 7.75%, It was in the year, it was 2021, but it was a little higher than the average because this is normal mortgage rates. I was paying higher rates because I had a rental property, right? But if you see, I went from like 7.75% all the way down. I remember my lowest rate for a was around 5.5% for a rental, right? That was a drastic drop in interest rates, mortgage rates, right? So my profits went up. As rent was rising, margins just increased. They blew up, right? Now, you'll notice that we went through a recession right here, right? And this is, again, all this kabuki theater, this just stupid talk on CNBC where they have all these guests on that are overpaid to tell you that they believe a recession's coming. Okay, this is how stupid it is. Right here, .com bubble burst, right? And then you have X amount of quarters before the talking heads, the guys that are supposed to know everything, tell you what the past is like. And, oh, we're in recession, all right? Because it takes some time for all of those losses to ink through the economy, through corporations, and get to the real economy, right? Okay, so now coming into 2003, it started to get choppy here. Interest rates jumped up, they came back down. Then by mid 2005, the Federal Reserve announced they're going to start raising rates. They came out with their dot plot plan. And so I knew that they were going to be pumping rates up. And it sounds funny, but back then, the economy could not handle this rise right here from the mid fives to almost 7%. That's all it took to break the back. And I want to remind people, this is what people don't understand here. This rise right here is what led to negative amortization loans and the rise of adjustable rate mortgages, okay? The reason why is because the home prices were exploding so much that if you just price them in 30-year fixed mortgage terms, people couldn't afford it, right? Just like what we're seeing over here, where right now in the last literally 5 months, $400 more it costs on average, just on average. And that's if you have $80,000 down. Think about that. I don't care if you live in New York, I don't care if you live in California or these expensive locales. Think nationally. Get out of your own real estate bubble. And the reason why is this is a big deal. I don't care how cool, there's a lot of people that say, well, it's not stopping in my town. Well, you need to probably think a little bit more than 1 week, like the last time you checked, because things are rapidly slowing down, right? Not saying that they can fire back up. The Fed could go, here, let's print some money, let's give it out to everybody, let's drop rates into negative territory, and then let's watch this thing roll. The only problem is the Fed knows that's going to lead straight forward to straight up hyperinflation. So I believe that you're going to start seeing adjustable rates possibly trending downward, so they get cheaper, because right now adjustable rate mortgages doesn't even make sense because you're almost at the same darn price as a 30-year fixed, right? Now, again, I want to emphasize this part right here. The economy couldn't take it, right? So it was floundering down here. It came down. They started to trend down, right? Well, here's the Great Recession, right? That big, bold grayness. All right, now here's the deal. This is what's scary. So we've been trending. We have been literally, this is a massive chart, right? Going all the way back to 1971. This is what the prosperity looks like in the last decade. This is why everyone's made their millions, is on the cheapest interest rates ever, okay? Now, right before the pandemic started, guys, this is when I sold my house, my last house, and bought, Bitcoin and silver with it, right? Had that all stored away and hunkered down. A lot of people laughed because they said, look, your house has gone up another like 25-30%. I'm okay, because that month that I ended up selling and buying my Bitcoin, I bought it between 3,000 and 3,200 and 7,600 bucks, I think. So on the percentage basis, that money did well. Then I transferred it into something else, but like that did well, right? Look at where we're at now. This thing, as this trended down to just all-time record lows, never seen before. This is what we have, this rise. What does this remind you of? Now, it sounds funny because this is just equal to here. That's all we're at right now. But the reason why is because the 10-year bond is melting up. There are fewer people wanting to lock up money for that amount of time. Look at how fast. And remember, we're talking inflation. Inflation was rip-roaring by the late 70s. Pressure, and then you saw this. Now, even if you want to go back here, where it met this peak over here, 1975 all the way up to 1978, you could still look at these numbers trending and then look at how fast. Now that's the Volcker moment, right? Paul Volcker spiked rates to stop inflation. Do you think our Fed's going to do it? No way. They don't have the guts. And they don't have the guts because they know everybody knows now because of social media that they're the reasons why we're here. But then even after Volcker spiked rates, they dropped. Look at what happened next. Think about, now look at the length of that recession right there. Now, the reason why it wasn't as bad as this one, there wasn't as many derivatives. Matter of fact, there probably weren't a whole ton of derivatives at all in the markets. There was a lot of cleansing that had to happen here. So what do you think is about to happen over here? Guys, I want people to think more nationally as far as, you know, the whole bubble, the whole big thing, because if the bubble starts to pop in a place that, let's say, you look down on because it's not as fancy and as expensive as where you are, I don't care what you think, it's going to affect you. Nobody's going to be safe from this except for the people that are prepared. What is preparedness? Preparedness is not blowing a lot of money right now. Preparedness is saving money, getting out of debt, investing in solid inflation hedges. Wealthy people buy gold, silver. A lot of people are picking Bitcoin as their hedge, you know. However, it does track a lot with the stock market. It's really tied into the stock market. Okay, I just want to put that out there. Can you make a lot of money on it? Yes, you can. Can you lose a lot of money? Well, only if you sell. But the facts of the matter are the time you always want to sell is when the other deals are out there. Because think about it, and I'll close on this. When the deals are out there, it's because everybody's hurting, which means if you still have your money in certain classes, more than likely, you're feeling the pain as well. All right, guys, that being said, I thank you so much for watching the Economic Ninja. Is out.